Welcome to Westwood's U.S. Value Third Quarter Update webinar. Today, we will review the third quarter from a macro perspective, provide a bit of insight on what's driving the markets, and share a special spotlight on small cap stocks and how they may fare over the next few quarters. I'm Daniel House, Vice President of Institutional Sales at Westwood. Joining me today is Matt Lockridge, head of our U.S. Value team and portfolio manager on our large cap value and small cap value strategies. In addition, Matt covers research for the consumer staples and consumer discretionary sectors. Also joining us today is Fred Rousey. Fred is a portfolio manager on our small cap value strategy and a research analyst who covers stocks in the consumer discretionary sector. For today's presentation, first, Matt will provide an overview of the economy and stock market from a macro perspective and share our views on what's happening and what's driving stock market returns. In addition, he will provide some new information on how the U.S. Value team looks at the broad economy and how their assumptions provide a framework for the research process. Then we will turn to Fred, a member of the small cap value portfolio team, who will provide a special look at the small cap stock universe. It's been a tough time for small caps over the past decade, as small caps have trailed their large cap peers by nearly 500 basis points annualized. Fred will share some insights on this historic valuation opportunity in small cap stocks and why focusing on quality may be the best way to unlock potential of investing in small caps. Speaking of quality, I'd like to remind you that here at Westwood, our U.S. Value team seeks to invest at the intersection of quality and value. For more than 4 decades as an asset manager, we have focused on value investing and managing portfolios across the market cap spectrum. Our team of 11 investment professionals are research analysts first, organized by industry rather than market cap. Our approach to value is to find companies that sit at the intersection of quality and value, companies that are historically undervalued and mispriced, and that we're particularly looking for high-quality businesses with the potential for attractive future returns. Just a reminder that the webinar is being recorded, and we will send a link to the video along with the slides by email to all of those who've registered for the call. We'll also leave some time at the end for questions, so please use the Q&A box button at the bottom of your screen. We'll do our best to get to everyone's questions. And now I'll turn it over to Matt for the third quarter overview.
Great. Thank you, Daniel. And thanks everybody for joining today and taking the time. So again, I'm Matt Lockridge, head of U.S. Value and a portfolio manager on our small cap and large cap strategy. So what we thought we'd do is I'll just give a very brief overview of performance for the third quarter and then dive into some macroeconomic variables we find particularly important today before we get into the small cap opportunity that we see. So for the third quarter, it was obviously a difficult period for equities with all domestic styles down roughly mid-single digits. Value-led growth up and down the market cap spectrum, as those companies tend to have less pressure on valuations as interest rates rise. And we'll talk more about interest rates here in a moment. From a sector standpoint, energy led the way. It was up roughly 11% as the commodity crude oil rose 30% in the quarter on what we feel is a relatively balanced supply-demand equation. And on the flip side, what lagged were those more defensive areas, the bond proxy areas that tend to have higher dividend yields, such as real estate, utilities, and staples. On the next slide, we really get into what we feel was the story for the quarter, and that was the rapid rise in interest rates. The Fed obviously raised rates by 25 basis points in their meeting in July, but really the 10-year yield was what caught all of the headlines. It moved up roughly 80 basis points in the quarter and is even higher today. And this put pressure on all risk assets during the third quarter. And in our opinion, it was the market really beginning to believe in the higher for longer narrative. And we also had some economic indicators that were frankly better than expected during the period. Jobless claims were not picking up as many had expected them to. And some of the leading economic indicators were better than expected on a relative basis in the third quarter. But we would caution, from our standpoint, it's hard to take too much of a signal from this rise in rates in isolation. Don't read too much into this on the forward path of the economy, for example. It's very reminiscent of the 2005-2006 period, where we saw a 100 basis point rise in 10-year yield right before we entered the 2007 recession. But this was clearly front of mind for investors in the quarter. On the next slide, as we mentioned, the Fed raised rates by 25 basis points at their July meeting, which puts us further into a restrictive stance of monetary policy. So this chart shows Fed funds less CPI, and it really illustrates some of the previous Fed actions and the impact that has had on starting to bend the curve on inflation. And as we get real rates positive to this level, you'll see over time, this level of real rates has really preceded previous recessions. And so this tighter monetary stance will continue to slow both inflation and economic growth, in our opinion, as we move forward. On the next slide, we have an example of the pressure building on business. So this is the NFIB small business actual interest rate on loans that they're getting, and it's now over 9%, close to 10%. So at this level of a cost of capital, fewer projects are starting to really pencil. And so with fewer projects, there will be slower economic growth. And you can really see this in other interest rate sensitive areas of the economy. Our work is pointing to a real slowdown of in housing in the month of October as mortgages hit 8%. Or within autos, there was a data point the other day from Fitch that the percentage of subprime borrowers now delinquent on their loans has hit an all-time high now at 6%. So again, pressure is building throughout the economy. On the next slide, this really gives an overview of our economic framework as we look ahead. These are industry data points which are compiled by our research groups, which we discuss several times a year within our US Value team. This framework really represents our collective thinking on key variables as we look into 2024. And while these aren't specific targets, you can think of this really as a central tendency or an operative scenario as we look ahead. And it ensures that each of our analysts within US Value is using a common set of macro assumptions to do our fundamental research. And so this allows us to be able to effectively compare ideas by reward to risk across individual securities or across industry groups, again, because we're all using the same economic framework underlying our assumptions. And so broadly speaking, when you look at these variables, to us, economic activity will continue to slow into 2024 as higher interest rates and slower loan growth weighs on overall economic activity. In the commodity complex, we expect more or less a range-bound environment as supply constraints offset decelerating or deteriorating demand. And we're really watching as we get into 2024, we're watching for inflections, specifically with PMIs and certain areas of transports to really foreshadow an improvement in broader profit trends. So that summarizes our macro thinking today at a high level. And now I'll turn it to my colleague, Fred Rousey, to detail the opportunity we see today in the small cap asset class.
Thank you, Matt, and good afternoon, everyone. Thank you for taking the time to join us this afternoon. So this quarter, instead of a sector spotlight, we thought it would be helpful to provide what we think is a really timely update on the small cap asset class, given the historic valuation opportunity we see developing. On this slide, Daniel did a good job of highlighting the relatively underwhelming performance of small cap over the last decade. Really, we haven't seen the small cap size premium be realized like we would normally expect and like we have seen historically. And the same is true over the trailing 5-year time period, as you can see in this chart. The Russell 1000 has generated annualized returns of 9.6% as compared with the Russell 2000 up 2.4%. And as you can see, much of that underperformance has been concentrated in the last 2 years or so. As PMIs rolled over, the performance gap became much more pronounced, and we've yet to see any real change in this trend. So in this highly uncertain macroeconomic environment, large caps have certainly fared much better than small caps. In fact, the Russell 2000 value is still down over 20% from its last peak in late 2021. So we're going on a 2-year bear cycle in small caps, while large caps have experienced really only modest declines. There's differences in sector composition that have contributed to that. Large cap indices have a much higher weighting in technology, whereas small caps have a heavier weighting in financials and industrials. And with the higher interest rates and fears of an impending recession, investors have definitely demonstrated a clear preference for larger, financially healthier companies perceived as less sensitive to economic headwinds. On the next slide, you can see after a protracted period of underperformance that we've experienced in small caps, valuations in the asset class are among the lowest levels in decades. The Russell 2000 forward PE multiple, excluding non-earners, currently sits at just under 13 times, representing a 15% discount versus its long-term historical average. And it's not just on a PE basis. We see a similar discount across most other valuation metrics for the small cap asset class. So at this point in time, small caps screen as cheap, not just relative to its own history, but relative to the larger cap space as well. The relative forward PE multiple of the Russell 2000 versus the Russell 1000 sits 30% below its long-term average at 0.72 times, levels not seen since the 1999-2000 dot-com bubble. And we know that valuations, while they may not be the best short-term timing tool, they really matter over the long run. And forward-looking performance coming out of these more difficult periods of depressed valuation really can be quite compelling. For example, in the decade that followed the tech bubble, small cap outperformed large cap 80% of the time and by an average of over 400 basis points per year. So in our view, the pendulum has really swung too far and will eventually start moving back in favor of small caps. The timing depends somewhat on the Fed and the ultimate path of the US economy, as Matt highlighted. A hard landing, I think, would likely push out the small cap recovery, but that's not our base case. And we think the fundamental underpinnings of a new small cap outperformance cycle are really favorable. On the next slide, one of the most important underpinnings, that fundamental underpinnings that we see is earnings growth. And on this slide, what we're trying to highlight is that, while consensus small cap earnings are expected to fall for a second straight year in 2023, the outlook for 2024 is much better as we see continued normalization of macroeconomic conditions and a broadening of the earnings recovery that definitely favors small caps. So for 2024, you see consensus estimates for EPS growth above 20% for the small cap space, while it's relatively stable year over year at 8% for the large cap universe. Small cap companies tend to be more domestic and service oriented than their larger cap counterparts. I think this should prove attractive in the face of the stronger US dollar and rising geopolitical tensions that we're seeing. They should also enjoy greater leverage to several structural changes taking place within the US economy, including growth in US CapEx and infrastructure spending. We really view this as additional support to the long-term earnings growth outlook favoring the small cap space. And even if consensus estimates prove overly optimistic, we think small caps should start to realize stronger relative performance once investors really start to discount next year's superior earnings growth profile. On the next slide, there's one important caveat to the opportunity in small cap that we'll continue to emphasize, and that's the importance of quality. So in the Russell 2000, there are a historically high number of companies operating with zero sales and or negative earnings. Additionally, since the early 2000s, small cap indices have experienced a really consistent but gradual decline in median margins and returns, as you can see in that chart on the bottom right-hand side of the slide. These companies are more vulnerable to financial distress, particularly in the face of higher interest rates and tighter credit conditions, which we highlight on the next slide. Next slide, please. Small caps tend to have higher net leverage and greater interest rate risk with a higher mix of floating rate debt. RBC did a study that showed roughly 37% of small caps debt is variable rate versus only 15% for large cap. Therefore, they've definitely felt the brunt of the sharp increase in interest rates that we highlight again here on this page with the NFIB small business actual interest rate on loans. Small caps also tend to have a shorter average maturity profile than large caps, which can be seen on the chart on the right. Assuming they can refinance, they still face the risk of having to pay much higher rates for that debt when they need it. And all of this underscores, again, the importance of an active, fundamental bottom-up approach within the small cap asset class. Looking at it from a factor standpoint on the next slide, you can see that quality truly is a source of persistent outperformance over the long run. And you can see for more than a decade, small cap stocks with quality characteristics, as shown by those with the highest return on invested capital here in the dark blue line, have outperformed those with lower quality indicators such as negative earnings and high volatility or beta. And here at Westwood, as Daniel highlighted, we like to invest at the intersection of quality and value. And this is what that looks like for the small cap value portfolio here at Westwood. As you can see, the PE over the last 5 years has been well below that of the Russell 2000 value. Whether you look at it based on consensus estimates or based on our own proprietary internal projections for earnings. And quality is also much better, notably higher than the index. So we think that intersection is really important and one that we look to achieve quarter in and quarter out. And the result of that is consistent, repeatable alpha generation across different market environments. So this chart shows the full data set of rolling 5-year returns since inception, and we're ahead in almost every single quarter, which is impressive. But if you look at the table on the right, you can see that we have not only outperformed across different types of markets, but the largest area of value added has historically come in down periods. So that's the return profile that we're really trying to generate on behalf of our clients here at Westwood by investing at the intersection of quality and value. On the next slide, I'll highlight one area that we continue to be excited about in the small cap portfolio, and that's our industrials. It's been a source of alpha for the strategy over the long run. We've really found that it's a big universe of high quality names that we can pick from. Some more cyclical than others. But we see, a lot of opportunity, continue to see a lot of opportunity to benefit from stock selection within the industrials space. And for those of you who tuned into the webinar last quarter, you got to hear our story on electrification. But we see, several other, structural, tailwinds that small cap industrials will be able to benefit from over the coming years, deglobalization and reshoring of manufacturing, and of course, infrastructure investments. So, using our bottom-up fundamental approach, we're really confident that we're able to build a portfolio of diversified industrial holdings with really strong company-specific underpinnings and an ability to benefit from some of these longer-term trends that we see in the marketplace. And with that, Daniel, I think we're ready to open it up for
Thanks,
Q&A.
Fred and Matt. We appreciate the macro overview and particularly your insights on the current valuations within small caps, but also the importance of quality within the small cap space. So now it's time to turn over for questions. As a reminder, we have a Q&A button at the bottom of the screen. You type your questions in, we'll see them right away and have those answered. Our first question is for Fred. Fred, regarding the interest rates in small cap stocks, if we are continuing to be in a higher for longer scenario where treasuries might be near or around 5% for the next 12 to 18 months, how will that impact small cap stocks?
That's certainly a scenario we are actively discussing. We think it could exert additional pressure on small cap stocks. particularly at the low end of the quality spectrum, as we discussed. So it really goes back to the importance of quality and the ability to identify companies that produce strong free cash flow generation, while being able to maintain conservative balance sheets and really, self-fund, their operations and not rely on the need to go to the capital markets for financing.
Great. And the next question is for Matt. Matt, it seems we're hearing some mixed messages on consumer spending. I've heard that consumers are ready to spend for the holiday season. At the same time, we're seeing higher credit card balances, higher interest rates, and the resumption of student loan payments. And that's all going to take a toll on the consumer. What's your latest intel on the U.S. consumer, and what are your thoughts on the upcoming holiday season?
Sure. Yeah. So our analysts think the holiday is going to be running in the 3 to 4% growth range. So more normal levels of spending versus the nearly 8% last year. And that deceleration has to do with some of the factors, you listed: higher interest rates, higher inflation, student loan payments kicking in. And we very well may have a year-over-year drag now from gasoline in the fourth quarter. And I would say in addition to that, our analysts are really calling out, some nuances within that spending. So the search for value this year, we'll see more purposeful spending and likely seeing more trade down by consumers into channels such as the mass channel or discount channel. Our analysts also think you're probably going to see more of a balance between brick and mortar and online spending than you have over the last couple of years, and also some category shifts, potentially more in favor of consumer electronics, and away from areas like apparel. But the 3 to 4% range is really how we're thinking about holiday for this year.
Great. And one final question we have regarding small cap stocks and the valuation opportunity we're seeing today. What types of catalysts do you think we might see that could begin the turnaround for small cap companies?
Yeah, I would say typically if you look back over time at prior cycles, the small cap asset class tends to lead early in a cycle as profit growth is reaccelerating and profit growth is really broadening out across the economy. And that's really what I would expect as we look ahead. And so the question is, well, okay, how do you anticipate that? And we would really be looking at some of the PMI data that comes out, specifically new orders. That is really one of the best leading indicators of corporate profit trends. So we're watching that very closely. Also, we're watching certain areas, as I mentioned, in transports, like trucking rates, for example, which is a really good leading indicator. And so as that tightens, that's a signal that demand is improving and would probably be a leading indicator for the overall small cap asset class, as well as broader economic growth.
Excellent. Well, thanks again to Matt and Fred for joining us today. Appreciate your insights and commentary. And thanks to everybody who's on the call for joining us today. Just a quick reminder that we'll be sending out a link to the recorded presentation and as well as the slides over the next week or so. So please be on the lookout for that. Also, be sure to take a few seconds to review our exciting disclosure on the following slide. Thank you for your time today. We look forward to seeing you soon.